Good afternoon, friends, and good morning for friends from Europe. Welcome to our Quantitative History Webinar. Today, this should be the 23rd webinar for our Quantitative History series. So today, we are very honored to have Professor Fabio Braggion from Tilburg University to present his research on a very interesting topic on financial history. Professor Braggion is professor of finance and financial history at University of Tilburg, and his research covers a lot of interesting and important topics, and the research context actually covered not only Europe, but also China. Recently, he has a very interesting paper on the importance of the credit or financial crisis in triggering the social unrest in the early 20th century China. So today, Professor Fabio Braggion will talk about the financial history in the context of Germany. He will use the German hyperinflation as an experiment to talk about the investors' response and behavior to the inflation. So Professor Fabio will present for 1 hour. After that, we will turn to the discussion and the Q&A session. So for the audience, please leave your questions and comments in our Q&A box. Today, we will invite our Hong Kong U colleague, Professor Andrew Sinclair, to be our special discussant. So now, welcome, Professor Fabio.
Thank you. Thank you very much, Isheng. It's great to be here. Too bad I cannot be in person, but already, at least being virtually is great. So I just share my slides. I think you should see them. So this is a joint work with Felix von Meyerinck and Nic Schaub. And so as Isheng said, this is a paper about inflation and investor behavior, how investors' financial decisions react to inflation. So you have to see this paper as a study of individual investors' financial decision under an environment of inflation. And we are looking at this particular question by studying stock and bond investment in Germany in the period of hyperinflation, so between 1920 and about 1924. In particular, what questions we want to address. So we want to see how individual investors trade when they expect high inflation, and I mean trading financial markets. So in particular, we're going to see whether they buy stock, they sell stock, how do they trade other securities, and do they act rationally, or maybe do they suffer from an illusion, that is, they get confused when they have to distinguish between nominal quantities and real quantities. Why do we believe that this is an important and interesting question to look at? We know, now we're all economists, we know that inflation risk is one of the most important economic risks that are faced by investors. And theory, in a way, is ambiguous about the predictions of how investors may react in their financial decisions to expected inflation. On the one hand, you may have rational investors which understand that stock are always a claim on real asset, and as a result are going to protect the real value of investment from inflation to come. And as a result, they may be more likely to invest into stock because, again, they understand that stock protects them from inflation. And this is the type of literature that claims that this could be the case, or at least in theory, this could be the case. On the other hand, you may have more illusion investors, which, again, they make confusion between nominal and real quantities. And as a result, they may discount the future cash flow of stocks with a nominal rather than real discount rate. I will be more clear later on what I mean with that. And because they discount future cash flow with nominal rather than the real discount rate, they undervalue equity, and as a result, they'll be more likely to sell equity when they expect higher inflation. So theory is ambiguous about what will be the predictions of what investors would do when they face high expected inflation, and a little bit more looking at where we stand now and what may happen with our economy in the hopefully post-COVID era. So there has been various pieces on the financial press, but also famous economists talking about it. Maybe inflation is coming back. So now we are experiencing very low rate of inflation, sometimes also zero inflations. But because of the unconventional monetary policies that can be set up by central banks as a result of the later of the 2008 financial crisis, the euro crisis, and now the pandemic, so there has been some attention in maybe inflation is going to come back, and maybe welcome or not, but overall the various actions of central banks may pave the way for a return on inflation. So I think it's interesting so to get extra evidence, additional evidence on topics we don't know, such as, for instance, really how an individual investor is going to trade when faced with the expectation that inflation may rise in the near future. And then, as I told you, we are going to talk about individual investors. And another trend that we have been observing in the last 30 or 20 years is the proportion of individual investors, also because of changes in technologies and reductions in the access cost to public financial markets. So the proportion of individual investors into financial markets has been steadily increasing, moving, for instance, in the US from 30 to 50%, depending how you see it. But also in emerging markets, where we know that inflation is already high, most of investors trading in public markets in emerging economies tend to be individual investors. So in a way, this question is interesting both when we look at developed economies trends in financial market as well as emerging economies. So in a way, our goal is to understand how individual investors trade in stock and other securities when faced with the expectation of higher inflation. And we want to tackle this empirically, but once you want to do this, you are confronted, we believe, with at least 3 big empirical challenges. First of all, ideally, we would like to have granular data on investor security transactions, and this will allow us to control for investors and stock characteristics, to hold constant investors and the stock or security characteristics. Then, second point, we would like to have an environment where inflation is high enough so that investors won't overlook it. In a way, when inflation is positive but still low, investors may be driven by some sort of rational inattention and not really care about it, not because they're really making a mistake, but because rationally they believe it's not something worth to look at, and as a result, because they believe the losses, rationally believe the losses coming from overlooking inflation are so small, which is not worth the bother of caring about inflation. So we would like to have an environment where we are fairly sure that these investors are really paying attention to inflation. And then I've been talking about expected inflation. So we would like to have a good proxy of expected inflation, which also varies across places and throughout time, which is going to allows us to control for instance, time average fixed effects or location fixed effects, individual fixed effects. So we believe that by looking at Germany between 1920 and 1924, we have a chance of building up, we have a chance of having an environment and building up a data set that allows us to overcome the 3 empirical challenges that I just told you. Because you will see that by looking at Germany, we have enough data that are individual level, and they are data on trading of individual investors in securities that were traded in Germany during the time period, again, that I told you, between 1920 and 1924. So we have granular data that allows us to control for time trends and investors' characteristics and security characteristics. Second, we are going to look at a period of high inflation that then goes into hyperinflation. Inflation was high, you will see it, and it's very unlikely that investors will overlook it. Actually, it's way more likely, more natural for them that they were drawn into looking at inflation, because overlooking inflation would have resulted in very big financial losses. So this is the environment where high inflation naturally drew the attention of investors, and as a result, we can rule out explanations driven by rational inattention. And then we have the possibility, by looking at this time period, to have enough information on local inflation. But this, again, I want to emphasize local inflation. So we see we're able to construct inflation rates at city level. So we have information on local inflation that displays large variation throughout time, and because, as I told you, these inflation rates are built at city level, also across cities. The nice thing of having local inflation data is I'm relying here on recent paper by D'Acunto, Maluendier, and Weber, where the idea of having local inflation and see really how much is likely a certain individual spending money in his own basket of goods is a good proxy for expected inflation, because the evidence that you have is that your own direct personal experience in what you spend every day in a way forms your expectations of inflation in the near future. So by looking at local inflation data, we have a better idea of what could be the inflation expectations of individuals in our sample people. So in a way, Germany through the hyperinflation allows us to have the environment and the data that brings us over the three empirical challenges I just outlined in the slide before. Other interesting things about Germany between 1920 and 24 is, you will see, so we're going to use data from a large German banks, the clients of a large German banks, and we are going to look, so equity was in a way, or stock was a natural hedge against inflation, because given regulation in place in Germany between 1920 and 1924, trading in foreign exchange and investment in real estate was subject to strict regulation. So it was very difficult for investors to buy Forex, and given the regulation in place, it was not really profitable for investors actually to buy real estate. Then investment in derivatives, we have evidence that was fundamentally shut down already during the war, so buying derivatives wasn't really an option. And commodities like gold, so we are in a world where the gold was still the money. Germany was not on the gold standard, but everybody had the idea of going back to the gold standard. So gold was really a major commodity, in a way silver, but gold and silver were very scarce in Germany. So it was difficult for individuals to acquire this type of commodity, which is known also to be a cover for inflation. So in a way, what I want to say here, given the institutional environment and given the regulation in place, stock was really a natural hedge against inflation in the time period. So it's nice in a way that we can look at the behavior of these investors, and especially focusing on stock, because stock really should be the way to cover up yourself from possible expected inflation. And this is, I just want to give you here a preview of our results with one graph. What do I have here? So on the horizontal line, I have deciles of inflation that we record in our cities in certain period of times between 1920 and 1925. So it's basically is local inflation for decile of local inflations, where I'm basically putting in every decile CPI at time t, and again, order them from the lowest decile, low inflation, to the 10th decile, high inflation. So here basically are deciles of low inflation up to deciles of high inflation. And on the vertical line here, on the vertical axis, I have buy-selling balances of stock, which fundamentally is buys of investors of stock minus sales of investors of stock divided by total volume buys plus sell. And you can see that the higher inflation becomes, the smaller the buying selling balance are becoming. That is, with higher inflation, what happens is that investors in our sample are less likely to buy stocks and more likely to sell stocks. Results broadly consistent with money illusion. So that's the main point. Here, of course, you're going to have zillions, hopefully, or robustness tests that will convince you that there are no other effects or other channels that are driving these results. So in a way, consistent with the money illusion hypothesis, we find a negative relationship between the local inflation and the clients of our bank buy-selling balance. A 1% increase in local inflation decreases stock buy-selling balance of about 3%. The negative relationship is stronger with equity issue by firms that have high net leverage, which is another proposition of money illusion, which I just wanted to present you here in the preview of results, but I'm not sure I will have time to cover in the slides. And then it looks like, so we have a battery of robustness tests. It looks like the negative relationship that we found before between local inflation and buy-sell imbalances of stock is not driven by inflation being related or predicting bad economic outcomes. So you may expect, you're expecting higher inflation, you think the economy is doing badly, and as a result, you sell stock. Investors, so it also looks like this negative relationship is not driven by investors that are selling security, especially stock or equity, for consumption motives. That is, I'm observing prices that are going up, my income is not adjusting as fast, I need to sell my equity holdings in order to generate enough cash to buy bread and feed myself. Third, it doesn't look like this negative relationship that we found, again, between buy and selling balances of stock and local inflation doesn't look like to be driven by investors that are seeking other edges considered superior to equity, like real estate and foreign exchange. So that's a little bit of a preview of the results, and we're going to dig a little bit more into it in the slides to come. One interesting thing, so here you see a picture of Irving Fisher, who in 1928 wrote this small pamphlet called The Money Illusion, fundamentally describing the problem of money illusion and establishing what it's about, how can we define it, and how do we see it in reality. It's a great book. First of all, the book was fundamentally inspired by the experience of Germany in the early 1920s. And in a way, the results in our paper confirm the anecdotic evidence that Fisher is producing in his book. And I just to give you the idea, I wrote, I put on these slides a little extract out of a book, just again to give you the feel about it. So what Fisher says is, the German thought of the American gold dollar as rising. What does it mean? The Germans thought that we had somehow cornered the gold of the world and were charging an outrageous price for it. But to them, the mark was all the time the same mark. They lived and breathed and had their being in an atmosphere of marks, just as we in America live and breathe and have our being in an atmosphere of dollar. I like this quote because in a way I think we confirm it with our empirical analysis, but also convey the intuition of what money illusion is about. Fundamentally, people don't understand that the money is losing value, and we think of a raise of prices as just a raise of relative prices. In the example of Fisher is the dollar, there is a lack of supply of dollar that makes the dollar to become more expensive vis-a-vis the mark. In our context, you will see is people believe that higher interest rates are really higher real interest rates are not driven by the mark devaluing and the interest rate paying an inflation premium, but people understand it as for some reason or another in the money market, there is a shortage of something, of supply of securities or whatever, so that interest rates are going high. There is extra demand for securities so that the real interest rate goes high. So that's a little bit the idea of one illusion. I believe that this quote nicely conveyed, and in a way we see our results confirm the anecdotic evidence that Fisher presented throughout his book. And so how we believe we contribute to the existing literature on inflation and investors' behavior, or on inflation in general in financial markets. So the literature is huge, and I apologize if I don't give if I don't give right justice to every paper. I just wrote here a sort of summary. But in a way, so we believe we contribute first to the literature of investors' response to inflation. Most of this literature has been based on the analysis of share returns to inflation and looking at the correlation between share returns and expected inflation and also unexpected inflation. A group of papers found, for instance, a positive correlation between expected inflation and stock returns. Another group of papers found a negative correlation between stock returns and inflation. If negative correlation, some people believe this is driven by the fact that inflation is predicting bad economic outcomes. And as a result, high inflation today is predicting low returns tomorrow. Another literature believe that this negative correlation is actually consistent with money illusion. That is, if you have investors that suffer from money illusions, when inflation goes up, these investors are more likely to sell the stocks or agree on a lower valuation. As a result, this is going to lower share returns, generating the negative relationship between inflation today and coming share returns, stock returns. So our perspective, we take a different perspective than this literature. Rather than looking at prices, we actually look on how investors are trading. And we believe this is quite novel because we haven't seen any paper who takes a stand, that takes a stand. Then we look also, we believe we participate into the literature on individual investors' behavior and behavioral biases. Here I just put a sequence of papers that look at various biases of investors, for instance, under diversification, disposition effect, you name them. Our novelty here is we look at a particularly historically important type of bias that is actually money illusion, which again, to the best of our knowledge, has not been looked by studying the investor's perspective and how investors are trading. And then more generally speaking, we contribute also in our understanding on how hyperinflation evolved by looking at, by contributing in the macro literature that looks at on the monetary causes of hyperinflation, on how hyperinflation contributes itself on the expectation of inflation of economic agents. So that's a little bit in terms of preview and what we believe our contribution. Let me give you a little bit of an historical background about our environment and Germany in the early 1920s. So as you certainly know, Germany lost the war. And as a result of defeating the war, Germany had plenty of financial obligations that needed to be addressed in a way or another. Some related to the wars, and some already were just there because as a government, as a state, you need to run business in your country. So, for instance, the German government had to pay pensions to war veterans, orphans, and widows. And on top, remember that Germany was the first country that established a systematic system of pension, this already in the 1880s by Bismarck, which people elderly were expecting to receive. And that was on charge of a state. Then there were war loans to be repaid, the reparation to the ally to be repaid, and again, all the various expenditure of running the state, so running justice, the police system, the army, you name it, put together some system of infrastructure and so on and so forth. So given all these financial obligations, where to find the money? So tax collection was problematic. The reason being that, again, Germany lost the war. Germany in late 1918 went through a revolution that ousted the emperor and overnight transformed the country into a republic, which was a very weak republic, not quite successful in keeping together the various states that made Germany all together. With, for instance, Brandenburg on the verge of the Bolshevik Revolution and Bavaria being the end of extreme right. So because the so-called Weimar Republic, the republic that came out after the empire as a result of the loss of the war, was relatively weak in imposing itself, tax collection was problematic. So we didn't have just the infrastructure and the political power of imposing and raising taxes. Actually, in 1921, for instance, a finance minister tries to raise taxes and was assassinated by the extreme right, Erzberger. On top of that, even if we were able to raise taxes, personal income was low. So that was another problem in organizing a system of tax collection. As a result of the loss of the war, Germany was cut out from international debt markets. So borrowing money was sort of out of the question. So there was only one option left, print money. And so they did. You see here the pattern of money supply. This is fundamentally M1, which steadily grows starting in 1914 with the war, and then grows even more after the war is lost. And you see here gets sort of out to end in the second half of 1922, where this is really the period of hyperinflation. Remember, our sample period will start in 1920, will arrive right after the stabilization policy in some regressions. And here, confirming that printing money that way had some effects, I'm plotting the stock market index, the value of the dollar in Reichsmark, then the value of the nominal value of a bond issued by the German government, and the CPI. Let's start from the CPI, which is the red dotted line. You see that in a way follows the behavior of money. So there is a mild increase between 1920 and 1921, and then the increase becomes more marked after 1921 within 1922, and in the second half of 1922 starts to get quite a very important increase. Same idea is quite correlated with the behavior of exchange rate dollar Reichsmark, and at the same time the stock market index replicates the same behavior. What we see is that the nominal value of the bonds remains fundamentally constant, because these are bonds. I need to give you your capital at the end of maturity. I need to give you the principal, and in fact you see that the nominal value of the bond remains constant. So we want to test money illusion or rationality. So I need to give you some theoretical backing on how things work. And I'll try to do it in the most simplest possible way, by using the Gordon-Grove model, which I think you're all familiar, and this is really Finance 101. So according to the Gordon-Grove model, or any discounted cash flow analysis, we know that the dividend price ratio, so here D stands for the dividend paid by the company next period divided by the price of a share today, is equal to the nominal discount rate minus the nominal growth rate of the cash flow of a company. Nominal. That's what I want to point out. So imagine now investors are expecting higher inflation to come. And imagine our investors are rational. So what a rational investor will do? So inflation is getting higher, so the investors will adjust the nominal discount rate to take into consideration that inflation is getting higher, and as a result, R will go up by the expected rate of inflation. But this is equity. Equity is a claim on something real, and the earnings that the company will obtain will also grow with the inflation rate. So the expected rate of cash flow has also to grow of the expected higher rate of inflation that you come. So fundamentally, R minus G increase of the same factor, the expected inflation factor, leaving the dividend to price ratio unaffected. So that's the idea that what you would expect if you have rational investors. Imagine that you have an investors that suffer of money illusion. So it's making confusion with nominal quantities and real quantities. What happens is, in this situation, you will, and you're really relying on a paper by Modigliani Con 1979 that really established this idea of money illusion on the side of investors. So you will have the investor to raise the nominal valuation of a nominal discount rate by the expected inflation factor, but in a way will forget to adjust the growth rate of the company. You will neglect that the earnings of a company will grow at the same rate of inflation that is expected. Okay? As a result, so R goes up, G remains constant, the whole dividend to price ratio goes up. keeping the dividend constant, it means the prices are going down. It means that this investor is undervaluing equity vis-a-vis the true value, vis-a-vis the true value of the stock. Intuition, how to interpret it. So because the investor in a way interprets the raise, the inflation premium that is paid by interest rates that goes into also the discount rate is really a rise in the real interest rate, in the real discount rate. A little bit what we saw with Fisher. He's forgetting that it's the currency that is losing money, but he's focusing only on this particular relative price, and he's raising only this particular relative price because he thinks that there is one price that really is increasing, rather than having all the nominal level that is going up the same way. So that's the idea. So what we find, as I told you, as a result of this valuation error, the investor stock valuation is lower than the actual market price, and the investors is less likely to buy and more likely to sell stock because is undervaluing equity vis-a-vis the true value, of it. And what we're going to do is we're going to capture this idea into this equation where for each investor in our sample, we're going to create this variable called buy-selling balances, which is equal to the buys, the number of buys of Mr. I at time t minus the number of sell of Mr. I at time t divided of stock or other securities, you will see, divided by the total volumes of buy or sell in a certain month. So it's going to be investor I in month t. You're going to control to start with investor fixed effect, month of year fixed effect, and this is our main independent variable, local inflation experienced by investor I at time t. And rationality will predict that I expected inflation, I will buy more equity, and money illusion will predict a negative beta in front of my expected inflation variable. Because with money illusion, again, the investor is more likely to undervalue equity, and as a result is more likely to sell it, especially believing that he may get a good deal because he believes that the value of the equity at a certain point will go down because equity is overvalued right now in his perspective on the market. So that's about the equation that you want to, the baseline equation that you want to test, but you'll see we're gonna run more tests on it and use also denser sets of fixed effects and certain specifications. Data. So as I told you before, we were able to get data from a large German private bank, which was serving as a broker for its client and was serving both, you see, both German and foreign customers. And we have information on the securities accounts on the private clients. In particular, we have name and surname of the clients, residence, holdings of securities, buy and sells, and the transaction prices that these clients were able to get. And just to give you an idea, this is how the data looks like. So this is one page of a security accounts of one client. So as an agreement with the bank, we need to respect GDPR here, even if this is data from the 1920. So I needed to delete the title, the name, and surname of the client, as well as the place of residence. But in the first line, you would have all this type of information. And then here you see that you have the trades that the client does. This is a bond traded by the client. And this is a piece of equity which is traded by the client. Actually, I think this is a bond. Sorry, my German is a little bit rusty. This is a bond traded by the client, and this is a piece of equity traded by the client. This is, you see, the amount of buys and sell. This is the date where this happens, and here you see the prices that are characterizing this type of transactions. So this is the raw data that we have, and you have to imagine these big ledgers where each client has a page, and fundamentally went systematically through each page of a ledger, collecting all these informations about the client herself or himself, and the trades undertaken by the client, as well as the price we were obtained by the client. So piece number one of our data, all this data from a large German private bank, where you have these clients that are trading securities and are using the bank fundamentally as a broker. Then because we put together also a second building block of our data that are the local inflation data. And this data was compiled by the German Statistical Office. So idea was, so the data is quite very interesting. So again, is local in the sense is compiled by each city. Why each city decided at a certain point to create data on CPI, which can be translated into inflation data? Because the Department of Labor needed information on local inflation to be used as a basis of wage negotiation. So that's why they started to systematically collect prices of various goods to create a sort of reliable index of CPI and inflation to be used again in the bargaining procedures between the government, the state, and labor and entrepreneurs. So the data is available on a monthly frequency. It starts in January 20 and covers every German town that at least has 10,000 inhabitants. And let me give again a screenshot of data for 1921. So this is one column with data. This is another column with the same type of data. So on the first column, fundamentally, you have the city that we are talking about. Notice here, for instance, at the end, you have Berlin. And then you have population of a city. And here you start to have inflation data for January, June, July, August, and September 1921. And here the base year is 1914. And here you have the same data for July, August, and September, but you can see here that the index number is based on January 1929 being 100 being the base. And this column basically is the same amount of information for other towns. So we put together all this data, we constructed measures of local inflation, which again varies by city, from city to city at the monthly level. And here I want to give you a little bit the geographical coverage of our data. So we were happy because, okay, you see, first of all, the black lines identify Germany as was in our sample period between 1920 and 1924. And the shaded gray area is Germany today. The red lines are towns in Germany, of course, for which you had at least one client. And then the green dots are towns in Germany for which we have at least one firm of which we observe a security in our database. And we were quite pleased when we saw this map because you see there is a nice geographical dispersion of clients and firms in our sample. I would say fundamentally all Germany is nicely represented. Of course, some parts, as you may expect, are more represented than others. So for instance, this is Berlin, this is the northern part with Hamburg, and this is the western part with Rhön, Cologne, and Bonn. But overall, you see that the dots are covering fundamentally every part of Germany. And this is a little bit the trend and dispersion of our local inflation data during our sample period. You see, so why these bars are vertical? Because fundamentally we are plotting every month all the inflation we observe for the cities, for the German cities for which we have the data. So you see that, first of all, as a trend, like we saw in the national inflation data, inflation goes up, especially after the second half of 1922. But you see that in each month, there is a nice dispersion of inflation. So especially at the beginning of a period, some cities even experience deflation. And when inflation goes up, yes, it goes up for everybody, but for some cities more than others. So you see large amount of dispersion also in 1923, when there is the big boom in inflation, there is really the proper period of hyperinflation. And why inflation goes down here, this is October, November 1923, because at a certain point, the German government undertakes a successful stabilization policy that brings back inflation to more reasonable level. So that's why you see inflation going down. And by the way, we are going to exploit in a test also this time period. A bit of descriptive statistics to also give you a better sense of the data. So as you can see, we have data for about 2,000 and almost 300 customers. 72% of them were male. Almost 90% of them were German citizens. 97% of them were living in Europe. And in average, our clients have been trading with our bank for 3.3 years, so three years and about 4 months. Almost 10% of our customers had a bank account with another bank, which was not, of course, the bank that we have the data from. So as from portfolio characteristics, in average, a portfolio of our client was made by a little bit more than 3 securities. And this is interesting because in a way, it's quite similar to more contemporary data. When you look, for instance, at the papers by Bernardin, you more or less have the same type of numbers. 49% of them are stock, 31% are bonds, and 13% are foreign securities. 11% of our clients are trading on margin, so they have positive leverage on their account. So fundamentally, we are borrowing money to trade. When you look at the trade characteristics, a client makes about 0.78, almost 1 trade per month. 50% of his trades are buys, of which 50% again are trades of stock, 30% bonds, and some foreign securities later on. And these are all the data on the average buy-selling balance of stock, the average buy-selling balance of bonds, and this is the average buy-selling balance for Forex. And you see there are way less trades on Forex. But before getting into the real analysis, I think most of you, after especially the survey map, is okay, what can be a determinant of local inflation, why local inflation is different from city to city. So we want to give you some sort of a sense of what are the drivers of inflations from location to location. And that's the table is really want to address these ideas, or to give you a feel of why different cities are experiencing different inflation rates. So this is a panel analysis, fundamentally, where the unit of observation is inflation in CTI at time t, and we relate it to various city characteristics for CTI at time t. So we start univariate and then we go multivariate in the last column, but we see there is a positive relationship between population of a city in 1919 and local inflation. So larger cities tend to experience higher inflation. If a city was occupied, and occupied, I really have in mind the French-Belgian occupation of Western Germany after 1920, in 1921, if at a certain point the city was occupied by foreign forces, inflation was higher. There is something that reminds you of a Phillips curve, because a higher unemployment rate is also correlated with low local inflation rate, and here unemployment rate is at the city level. Then column 4 and 5, we look a little bit more of the money channel for it. I don't know what to call it, but you see that if a city has a branch of a Reichsbank, inflation also tends to be higher. And then we look at these 2 variables that may look strange to you, but let me explain them. We look at the percentage of employees in the cities that are employed by paper manufacturing and printing manufacturing. There is not much going on for paper manufacturing, but you see that cities that have a larger proportion of employees into the printing manufacturing experience also higher inflation. Idea being, remember that at a certain point, there was really a need of a central bank to really print money to serve the public, especially after 1922. So printing presses and paper makers were basically taken by the central bank in order to physically print the currency and distribute it around. And so you may expect that when in locations where printing facilities or paper makers are closer, the money will flow more directly and quicker, and as a result, local inflation may spike up. And that we find it especially for the importance of the printing industry. So in cities where in principle you have more people working in the printing industry, local inflation is also higher. When we put in a sort of horse race all the variables all together, and we see that occupied is still positive and statistically significant, we still find a negative relationship with local unemployment rate, and printing also still is positive and statistically significant. Now, let me go into the main results. So, as I showed you in a few slides ago, we want to relate buy-selling balances of investor I time t with local inflation experienced by investor I at time t, controlling for various facts. And here I'm looking at the buy-sell imbalances for stocks. And you see that in all the specifications I have, there is always a negative relationship between local inflation, that is, in a way, our proxy of expected inflation of investor I, and the buy-sell imbalances of stock. That is, when local inflation goes up, investor I is less likely to buy stock and more likely to sell stock. The coefficients are pretty similar for our specification. We start in a specification that doesn't use client or investor fixed effect. Then we're introducing investor fixed effect. When we are changing the timing of local inflation, not the contemporary one, but 1 month ago, results are still the same. Then we control for the local unemployment rate and whether the city was occupied or not in our time period. Results are the same. And we see that the results is there also when we split the sample in January 20, August 1922, where inflation was high, but still kind of moderate. And September 92, September 1923, proper hyperinflation. In both cases, coefficients are negative and statistically significant. Economic significance, so you can interpret this coefficient as a 1% increase in local inflation leads to a decline of a buy-sell imbalance of about 3%. Then you also exploit the panel characteristics of the fact that we have investors' characteristics in our sample, with information about something about investors. And we create few proxies that in a way want to show how experienced or well acquainted with financial markets, or sophisticated, if you want, are the investors in our sample. So in principle, wealthier investors should be more acquainted and more sophisticated in dealing with stocks and financial market. Then we have a direct measure of experience, which is the number of trades that have been made prior to the particular trade. And then whether investor is trading on margin or not. Usually, smart investors, we have also evidence of this, anecdotal evidence, would have been trading on margin, which makes sense. With high inflation, you want to issue debt because in few days your debt is going to be worth nothing and you can make more money with that. So in all the situations, we see that the effect is attenuated for investors that, according to our measures, tend to be more sophisticated. So we see that as a baseline, it is true that all the average investor tends to sell when inflation gets higher. But we see that the effect is less strong for wealthy investors, experienced investors, and investors that are trading on margin. So overall, looks like if you have a bit more experience, you suffer less of this small illusion type of issue. Then we are going to also look at the performance of the trades of investors. So idea being the following. So we want to see a little bit whether we are timing the trades in a good way or not. And this is, again, we want to see whether we're able to give a sort of consistent pictures of money illusion. So in principle, I told you, a money illusion investor believes that the stock is undervalued. Imagine it's correct, doesn't suffer from money illusion. If a stock is really undervalued and an investor sells, and again, if a stock is really undervalued and the investor sells, real stock return should be negative after the sale. Because if you're really if investor thinks the stock is really undervalued and investor sell, real stock return should be negative after the sales, because stock should, in a way, revert and go back to the true fundamental value. Remember, here I'm saying if the investor is not making any mistake, he's not making any error, he thinks the stock is undervalued and is actually correct. So if he sells, you would expect that at a certain point, share return should revert back to the fundamental value. As a result, share return should become negative. If an investor suffers from money illusion on the other end, real stock return should not be negative after the sale, because in a way, the investor is making an error. So we relate the after-sale stock returns in a certain period of time to the local inflation experienced by the investor at the time of the sale. So T is the time of the sale. When we compute the return of the stock that was sold between the month after the sale and tau months, which can be 3 and 6 months after the sale. And what do you see? The higher is inflation, the higher are the stock return of a sale. In two cases are statistically significant, in other two cases are not statistically significant, but still positive. Importantly, the stock returns are not negative. We suggest that the investor is actually making a trading mistake, because if he didn't make a trading mistake, you would expect that with higher inflation, the stocks would be negative, or after a sale, stocks will experience negative returns. Then, going back to buy-sell imbalances, I'm also checking the relationship between inflation, and we're also checking the relationship between inflation and bond rates. And we see overall positive coefficients, so higher local inflation, the investor is more likely to buy bonds and less likely to sell bonds. This is not statistically significant for contemporaneous inflation, although positive, and is positive when we look at the local inflation 1 month prior to the sale. And if you look at the economic significance, a 1% increase in local inflation leads to an increase in buy-sell imbalance between 5 and 10%. This is interesting because in a way we see that the effect of selling security goes especially via shares, as Mod Illusion will tell you, and not via bonds. In principle, a bond investor should not make a mistake even if he suffers from Mod Illusion, because it doesn't have to correct for the G. Bond always gives you a fixed claim on the bond itself, always pay you a fixed principal. So the investor doesn't have to update the growth rate of cash flow. And as a result, a Mod Illusion investor should not make any mistake in bond. Now, to the extent that the bond price is lower enough when inflation goes up, it's perfectly possible and fair that an investor may buy bond by looking only at expected inflation. And that's in a way is what we find. Then we start to look at the other things and try to see whether this relationship that we are finding is really driven by what you have in mind. So first of all, we look at the inflation, the stabilization policy. Then we are going to check whether inflation is correlated with bad economic outcomes, whether inflation predicts future cash flow, whether investors sell stock to consume, whether investors sell stock to buy a better edge, and alternative trading measure. Let's see how much I'm able to cover. So stabilization policy and stock investment. So the baseline analysis that I showed you is undertaken in an environment where inflation increases. We saw it, no? It goes up for the sample period. It would be nice to show that we are able to observe exactly the reverse result, that is, inflation go down and investment in stock goes up in an environment, again, when inflation goes down. So it would be nice to see whether everything is reverted if you find an experiment where inflation is going down. So we have the experiment because in October 1923, the German government stabilizes inflation by introducing a new currency, stopping the central bank printing money to finance government deficit, and changing the fiscal policy, this on the side of the government, by reducing public expenditure. So inflation goes down, and we saw it also in the graph. We see that there is a big drop of inflation at the end of 1923, beginning of 1924. So what we do fundamentally a diff in diff analysis, where we have different investors exposed to different inflation rates before the stabilization policy. So we take the average inflation rate experienced by our investors between April and September 1923, right before the introduction of the stabilization policy. And we see how investors who experience different inflation severity before the reform trade after the reform. And in fact, we see that investors that experienced higher inflation after the reform, which possibly lead them to sell more before, and have a stronger readjustment of their expectation as a result of the stabilization policies, are more likely to buy equity. So the idea is, because I have higher expectation of inflation and the reform is changing in a more significant way my expectation of inflation, the reform leads me to buy more equity. So reducing inflation expectation via the reforms leads to buy more equity for investors that have higher inflation expectations. Then to the extent that a German investor had higher inflation expectations vis-à-vis investors not located in Germany, we see that German investors go back to equity after the introduction of a stabilization policy vis-à-vis a foreign investor. So you see here in my diff in diff, the coefficients are always positive and statistically significant. We restrict foreign investors, our control group, into neighboring countries, or investors that are living abroad but within 125 kilometers from a border, and we also have a propensity score matching. All this specification gives the same results. German investors, which in principle are more likely to have higher inflation expectation pre-reform, as a result of reform, go back more into equity. And here you see also the, go quick on it, you have some sort of nice pre-trend results. Inflation could be a proxy of current economic conditions. And this is very much goes back on the early paper of Fama and Schwert, Fama, Beckert, and Fama 1981, and Beckert and Wang in the review paper of 2010. So to the extent that inflation is proxied with bad economic condition, high inflation is telling you companies are doing poorly and you sell more equity. So you don't suffer from an illusion. You're just rationally reacting to some information that inflation is conveying to you. That is, the economy is not doing bad, it's not doing well. So how we tackle this? There are two tests for that. So first of all, we look at buy-selling balances again. But before, the main specification was buy-selling balances of investor I at time t. Now we open up to a third dimension. We look at buy-selling balance of investor I for stock J at time t, because we also have a stock level information, which allows us to control for everything we controlled before, plus in stock time fixed effect. That is stock times months fixed effect, which in a way controls anything that is related to the stock and the underlying company that changes every month. Any factor that is changing for stock J at time t is captured into this fixed effect. What factors? Also the possibility that the stock may suffer of bad economic conditions. Anyway, should control any omitted variable that is correlated with inflation, may actually convey information about how well stock and economic conditions are going. So remember, buy-selling balance of IJT is of investor A for stock J in month T. And this is the stock month fixed effect, which control again for time varying companies characteristics. And here are the results of new specifications, where I'm basically increasing piecewise the controls, the fixed effect controls. But you see that also in this tougher specification, we still find a negative relationship between local inflation and the buy-selling balances of individual stocks. That is, higher inflation today, the investor is less likely to buy, more likely to sell to stock J at time t. But again, about economic news, the idea that inflation can be correlated about economic news. Maybe the inflation could also be correlated to future bad economic news. So you're observing high inflation today, you expect that in the near future, the economy will do badly. And as a result, you sell stock. So again, this is not an illusion. You are rationally reacting to some piece of information which is conveyed by inflation. So the way we go about it is the following. So if inflation conveys a bad news about future economic prospects, individuals who are exposed to high inflation will have worse expectation than individuals that were not exposed to high inflation. So if you keep on seeing high inflation, you start to have bad expectations about the future. If you don't see much high inflation, you will be a bit more optimistic about the future, allow you to retain some extra equity. You may be less likely to sell. Good news for us is if an actual bad news happens, this is going to have an impact of a prior of investors. Especially, imagine you are an investor who always faced low inflation. So you relatively have a good prior about the economy. Now, if actual bad news happens about the economy, you have a higher revision of your prior, and as a result, you are more likely to sell stock vis-a-vis another investor who always experienced high inflation is more pessimistic than you. So that's what you want to exploit. And again, the good news for us were a good number of bad events that happened in Germany, which were released at a certain point, and not really expected by investors, which are likely to have affected the priors or more optimist investors vis-a-vis more pessimist investors. We're going to look at 4 bad events. The announcement of a reparation in 1921, the assassination of the finance minister in 1921, and Walter Rathenau, the foreign minister in 1923, and the invasion of the ruhr. These are all bad events that are likely to affect the priors of investors, and especially priors of more positive investors, which in our case would be the investors that experience low inflation so far. So we go with another diff analysis, where we look at the inflation experienced by our investors in their cities few months before the bad event happened. So for instance, in the announcement of reparation was in May 1921. We look at the local inflation experienced by investor I in his city between November 1920 until April 1921. The same idea is Erzberger is the assassination of a finance minister, Rathenau, the assassination of a foreign minister, and the invasion of the ruhr. And what you see is you have a sequence of positive coefficients that are never statistically significant, suggesting that the revision of expectations driven by these bad events is not strong enough to generate a good amount of trade, and suggesting that actually inflation is a proxy of bad economic conditions in the future. Then inflation as consumption motives. Clients are less likely, the idea is clients are less likely to buy and more likely to sell stock because they need cash to consume. So prices are going up. To the extent that your income is not growing as much as prices, you may be forced to sell equity just to generate extra cash to allow your self-consumption. But this is inconsistent with the results on bonds. Remember that when inflation goes up, our customers are more likely to buy bonds. And this, for me, doesn't really square with this type of explanation. If any, if I really want to sell something to consumer, I would probably sell first bonds and then equity. Then one thing we are looking at is different cities have wages that were indexed in different ways. So maybe if this story is correct, you may expect that the results are different in cities where wages are up to date, more frequently updated, more frequently with inflation. But this is something that we are still looking at it. In terms of inflation, is inflation and other hedges. So equity is not a good hedge. I'm going to look at real estate and forex. So investors' ability in Germany to trade in foreign exchange was severely restricted in our time period. Starting in 1920, German individuals could only exchange forex via bank, and they had to obtain a permission from the local authorities. The funny thing is, we have few trades in forex, in fact, but these trades are very strange bonds, which are all related to the losing powers of a war. So the few forex trade we see is, for instance, is in old Turkish bond or old Ottoman bonds, Bulgarian bonds. So these are all securities were issued by losing powers of World War I. Then, in October 1922, also the government made the law even more stringent on forex and fundamentally outlaw any trade on forex altogether. In terms of real estate, yes, you could buy a house, but rents were regulated and set at nominal values, with inflation growing a lot. So it wasn't really a good deal to buy a house. So this, in terms of idea, is unlikely that real estate and forex are going to change, the availability of real estate and forex are going to change our results, because it was very difficult to trade both in real estate and forex. We are going to exploit the fact that there was a tightening in the forex regulation, and in March 1922, rents were updated to the new price level to see whether any change in forex regulation or real estate regulation may affect our results. And we're going to do this again in the diff type of analysis that which methodology resembles one of the big events I showed you 2 slides ago, and the stabilization policy one. And we see there is not much going on here. Coefficients are not statistically significant, so it looks like even changes in regulation in this environment for forex and housing doesn't really affect the buy-selling balances. Then here, very quickly, I think I'm almost out of time. You see that we tried different measures of inflation. So the inflation measure that I showed you were fundamentally an inverse hyperbolic sign, which works like a log and allows us to have negative numbers, because we didn't want to throw away or set to zero negative inflation rates. But if you just use the raw local inflation rate without any transformation, results are going through. If I just use the log, results are going through. If I just use deciles instead of the continuous measures, the results are still going through. Then we also change our measure of buy-sell imbalances in various ways. We look at values rather than number of buys and sells, but you can see the results are still going through. And also, this is the last column. I'm going a little bit quicker. If you just look at the portfolio holdings, you see that also here results are going through. That is higher inflation, less portfolio holdings of equity. So wrap up. Conclusions. So we study the relationships between inflation and retail investors' decision in Germany between 1920 and 1924. Overall, we find a negative relationship between stock investment and inflation, and the results appear to be consistent with money illusion as proposed by the famous paper by Modigliani-Cohn, 1979. The idea when expect inflation goes up, you are making a mistake between nominal and real values. You're interpreting the high interest rate that you see as really a change in relative prices. Oh, these bonds are really paying me high interest rates. And as a result, you over discount equity, undervaluing it, making yourself or the investors making themselves less likely to buy and more likely to sell. So I guess this is it for today. Thanks a lot.
Thank you, Fabio.
I stop sharing.
Yeah, it's fine. You can keep that.
Okay.
Okay, thank you, Fabio, for the very wonderful talk. Well, now let's turn to our discussion session. In the first place, we would like to invite our colleague, Professor Andrew Sinclair, to give maybe 15 minutes discussion. Professor Andrew Sinclair is also a financial historian. Yeah, actually, we are co-authoring some projects in terms of the Chinese financial history. So, Andrew, please.
All right, thanks Chu Chang and Professor Chen for inviting me to speak today. And Fabio, thanks for presenting a great paper. Yeah, so German hyperinflation is actually my earliest memory of economic history. When I was in elementary school, we were learning about the rise of the Nazi Party. And in my textbooks, you know, you'd see these pictures of people carrying wheelbarrows full of cash to go buy bread, or you'd see like walls that were completely wallpapered in like paper currency. And you know, as a kid, that really makes a big impact, because like as a kid, you see, you know, your parents using paper currency, and it's like this little tiny thing, like just the smallest piece of paper, really thin, and you can buy lots of things with it. And so, you know, the fact that the inflation was so large, it really made a big impact on me. So yeah, I'm always excited to learn about it. So, you know, I really enjoyed the paper. I really enjoyed the talk. My first comment is about the link between the theory and the empirics. So for the money illusion, you know, when I think about money illusion, I think about this mostly as being about valuation. And I'm not 100% sure about what the implication of money illusion would be on trading. So if you think about it, you know, let's say I buy a stock, I pay 100 marks for this stock, I have it, and then I experience huge amounts of inflation. You know, my expectation for future inflation ends up going up. In the Gordon growth model, I'm looking at my future dividend stream and I'm discounting it at the nominal rate. So now instead of 100 marks, I value this at 90 marks. So I agree that, you know, I might value this cash flow stream less, but it's not clear what I would do for trading. So if everyone else believes the same thing I do, then it's not going to be trading at 100 marks. It's going to be trading at 90 marks, in which case I might not.
Nobody trades.
Yeah, nobody trades.
Yeah.
If nobody else believes the same thing I do, then it'll continue to trade at 100. And just because it's trading at 100 and I value it at 90, it doesn't necessarily mean I'll sell it. I might sell it if I believe that it'll come down to 90. But if this wedge exists, here we're talking about an asset that is determined by the market price. If the market price is 100 tomorrow, if it's 100 a week from now, I might as well just keep my money in that particular asset. So all I mean is, to close the logical loop, I think you need another assumption, just to make sure that we can make this link between the money illusion predicting a decrease in sales, or increase in sales, but a decrease in this buy to sell ratio. And so my second comment is about this prediction, this prediction of the negative relationship between inflation and the buy to sell ratio. I could see it being consistent with the money illusion, but I could also see it being consistent with the hedging hypothesis. Why do I buy stocks under the hedging hypothesis? I'm buying it to hedge. Today I'm concerned about future inflation, so I end up buying a lot of stocks. Tomorrow, if there is a lot of inflation, inflation's very high, well, then my hedge is paid off. I'm in a high marginal utility state of the world and my hedge is paid off. If I don't need to consume, then I'm not going to do anything. But if I need to consume, then I'll end up selling those stocks. So there you'd have a relationship where high inflation would be related to selling, essentially my hedge. In a sense, it's related to your liquidity story a little bit. And in the paper, you rule out the liquidity story by looking at the difference in the buy to sell ratio between stocks and bonds. And I agree that, generally that's a story that makes sense. But here we're in a very unique time period. Here we're in a time period where, the markets are sort of in a crisis. Things are going a bit crazy. And if we look back at 2008, in that crisis, one lesson that we learned is that investors, when the crisis hit, they were selling their best assets. They were selling their most liquid assets. And so if I think about, if I have a liquidity shock and I'm holding stocks and bonds, in this time period, stocks might have a huge liquidity advantage over bonds. This is a period where stocks, they have this real value. Everybody wants stocks. Nobody wants bonds. Bonds are nominal. They're getting wiped out left, right, and center. And so I might actually, or it might be the case that if when I go to sell, I'm not going to sell my bonds because they're not liquid. I'm going to sell my stocks. So that might be another reason that ends up driving that particular relationship. Now, sort of thinking like a little bit more, stepping away a little bit from a lot of the complexities. If you think about the hedging motive, let's say it's at time zero. I'm deathly concerned about inflation. I'm very worried about inflation. So I put all of my assets in, all of my wealth in the one hedging asset I have, which is stocks. Put everything into stocks. Next month, what do? Next month I receive my paycheck, and then I'm going to take that paycheck and I'm going to put everything into stocks as well. And so here, I think this is why in general you see more buys than sells. You see on average generally throughout this whole period, there are more buys than sells because there is a big demand for these stocks. Now, if I'm putting my entire paycheck into the stock market, wages are sticky. If there's huge inflation, then this particular month, I can't put exactly the same value in the stock market. I have to take out from my paycheck, I have to take out a bunch of money to buy bread, to buy milk, and all of that has gone up. So in that sense, if that was the motivation, if it was purely hedging, and I had already had all of my wealth in the stock market, then each additional paycheck, if inflation was high, as inflation increases, I'd be able to put less and less of my wealth in the stock market, in which case you'd see the same sort of relationship. So, generally, I believe the result. I think money illusion is very real. I think inflation is terribly complicated. It's hard for a lot of us to understand, let alone people who aren't economists. And so I definitely believe that people are making mistakes, and I think the money illusion, I think the effect will be strong. But I think maybe in the paper you could try tightening up the logic a little bit and I think like spend more effort ruling out these alternative channels. Because I think at the end of the day, what you really want to say is, of course the hedging demand exists. Of course the money illusion demand exists. And it's really a question about the magnitudes. Which one is more important, which one dominates. So yeah, so thanks very much for presenting.
Thank you.
I really enjoyed it.
Thank you very much.
Thank you, Andrew. So Fabio, you can make some response to Andrew's comments.
Okay. So Andrew, fundamentally agree on everything you say. On the first point, we need to write it better in the paper. It's true. So imagine if you're in a world of homogeneous agents, you're all the same. There is no trade. In other words, we all agree. We shake our hands. Okay, we're all suffering from one illusion. Prices are low. We don't trade. So that's correct. We need to explain this better in the paper. In a way, that becomes an empirical question to be seen, right? So, yeah, if you'd ask me, so put explicit what is the underlying assumption behind what you're doing, there are some guys that are selling, somebody else must be buying. So, in fact, one thing we're working on is now try to reconstruct better the buying side, just to give better this idea. And you may expect that who buys is somebody particularly smart that understands better. So in a way, you already kind of present that when you see that the results is less strong for a wealthy guy's bond margin. But now we are coding another book of the bank itself, of the people related to the bank itself, and see whether they are taking the buying side, which in a way would suggest that, would help me to show that this assumption that we have behind, that these people are different.
Yeah, I think
in the data.
The heterogeneity you show in terms of sophistication,
yeah.
that's a very strong result. That I think goes a long way to showing that this is, something.
Yeah. So, but yeah, in a way, I think Andrew got blocked. In a way, we want to push the results further because, yeah, the implicit assumption is, you said, we are not all the same. So if you need to betray if you observe trade, somebody buys, somebody sells. We are catching the sell. I want to see the buy now. So, but I totally agree. Then I took a few notes. The liquidity story, true. So I don't know. We thought about it. So one possibility is also, remember, we have one specification. Maybe we have to put it more upfront, where we are looking at stock investor date. So to the extent that different securities have different degrees of liquidity at different time. So in a way, security times date fixed effect should pick up the liquidity. Maybe one thing you can do is also to pull together stock and bonds and see a little bit how the coefficient works. But I think the idea of opening up the baseline equation and having stock I better, security I at time t, security J traded by investor I at time t may help because the liquidity of a security will be picked up by the alpha JT. You see what I mean?
Yeah.
So that I think it could help. Then on the last part of the hedging motive, yeah, no, I agree. That's why we are considering this idea that different cities ended up with different type of indexation of the wages. So some cities were particularly good in staying up to date, other cities not. Actually, even profession, but we cannot use it too much because the miners were always up to date vis-a-vis other people, but not many miners were trading in stock, unfortunately. So maybe that would help because to the extent that your nominal wage, your nominal income is more up to date, I should see less of my effect. So that's something we are planning to explore and we are checking out. But yeah, no, I think the point is well taken. And I told you. Yeah, the edge pays off. Yeah, I don't know because here I'm always talking about expected inflation. So if you tell me the edge paid off, you become backward looking at a certain point.
Yeah.
So to the extent that inflation always goes up, I'm always looking up front. So yeah, but you see what I mean. So
yeah, I mean, you could even think of it as like the hedge paying off, but then because inflation is high, it sort of like compounded your future expectation of inflation. Like in a sense, the hedge paid off, but then you also have to put in a bigger hedge because now you're worried even more about the future case of inflation. So yeah.
That could be. Yeah, I think I told you everything. But overall, yeah, no, point well taken. So we are working on it. Thank you.
Thanks very much.
Okay, thank you both. So Professor Zhu Chen, do you have any comments now?
I just have one quick question, Fabio. So I wonder whether you can actually control for each region in Germany, whether that region is predominantly Lutheran or Catholic, or I guess they don't have many Calvinists, I guess, whether the religious dominance by one group may actually affect the local community's financial sophistication or not. So this is like in addition to your experience predictive variable. So that's one thing you can possibly add to the controls or to the X of predictive variables. Another possible explanatory factor may be whether the particular region had many persecution events of Jews in the Middle Ages, because you know, research publications by Joachim Worth and others have documented the long-term legacy of you know, the Middle Ages Jewish persecution events. So what I'm trying to say is that based on their research, communities that experienced a large number of Jewish persecutions in the Middle Ages will still have a lot of resistance to stock market investing and other financial instruments uses, even in the 20th century or 21st century. So I don't know whether that may explain some of the regional
variation.
Yeah.
Yeah, yeah, the data is where we can do it. So you're basically saying having interaction term, inflation times, Protestant region, inflation times, number of, yeah, but we can do it. Thank you. I see the channel.
Yeah, just like how you interacted inflation with financial sophistication instrument.
Yeah. We should go back to Andrew's point, show how people are different fundamentally, because that's if it's trade, we are different. So we show is basically showing how people are different. Yeah, thank you.
For one thing, if you use such variables by getting the data from Joachim Worth, because he's the managing editor of the economic journal, so you may get your paper into the economic journal more easily. Yeah. Anyway, just a joke. Yeah. Yeah. Thank you very much.
Thank you.
Okay, thank you, Professor Chen. So if no further question or comments, now let's turn to the audience question. Well, we have got some questions from the audience. The first one, is there enough local variation in inflation for it to proxy for inflation expectations versus the national level of inflation?
Yeah, there is. So you see it here in the graph already. Maybe I can put it again. So we believe there is. So, oops, sorry. Let me see if I have it in the descriptive statistics also. Here in the graph you see it. So there is quite so this is expressed in log term, or actually better, it's expressed in inverse hyperbolic sign. But you see that each time period there is quite good variation in the degree of inflation, especially if variation becomes larger, the more inflation becomes larger at national level. So, and overall, yeah, we see, let me see if I have it also on descriptive statistics. No, I don't have it here, but it is in the paper. So yeah, no, there is. Also, we find results. So it's not that if we put some time fixed effect, everything becomes statistically insignificant, as would be the case if there is very little variation, and we don't find crazy outliers that are driving the results. So overall, the graphical evidence plus what you observe in the regression suggests the variation is actually pretty good. Notice also in some cases cities are even experiencing deflation, and some other cities are experiencing inflation, so which also is consistent with the idea that we have quite a nice degree of variation.
Okay, the next one from the same audience. Were benchmarks printed locally, not centrally, and then distributed to localities?
I think we're doing both, actually. So especially at the beginning, I think was done centrally when you have extracts distributing. Then the need of Deutschmark became so intense that they started to take local printing presses just to print them. So what was sent out was fundamentally an order from the headquarters of the Reichsbank, print an X amount of Reichsmark, and the local printing press, which was this printing industry, this printing company that was being taken over or in a way seized by the central authorities, would have done it. In fact, notice, so also the results that you have, there is a positive association between percentage of people working in printed inflation suggests that this is the case. But yes, so historically it is true. So I remind you to some historiography of the Great Inflation that are describing this type of things.
Well, so the next we have 3 questions from maybe Professor Albrecht Rischel. The first one, are you aware of the work of Stephen Webb from the 1980s? It's interesting as concludes people expected inflation to end soon at every stage. Maybe I can finish his second question. Yeah, sorry. Have you tried tossing out the second half of 1923? The break point would be the abandonment of the rural struggle by the German government, which paradoxically leads to an explosion of inflation.
Yeah. So okay, yeah, on Web, yeah, we saw the work. Of course, the methodologies are different. So again, we are looking at the same problem from a different perspective. It is really collecting the data from investors. So I'm not saying that all the German public was suffering from an illusion. As discussing from Andrew, some people did not, some people did look cool business, some people did, some people did not. Remember also there is anecdotal evidence that some people made really lots of money out of inflation, such as Agustinus and all these type of people, which looks like they did it by also borrowing on margin and going in the stock exchange with that. So I think it's also important to address what you just saying, that we are going to look also a little bit more on the buy side of the trade. On your second question, so I think I'm still sharing, right? So, well, what I presented here was also, this is the table with the main results. Let me get it bigger, actually. No. This is the table with the main results. Notice that the last 2 columns were breaking the time period between January 1920, August 1922, and then September 1922, September 1923. It's not what you asked me, but you see that in any case, in the first time period, the effect is there. If I'm picking up more, so we did various breaks. So if I go into September 1922, November, and I enter into 1923, this column here gets a bit more similar to what we have here on the left. So it looks like the results is not driven by the last 4 or 5 months of hyperinflation.
Okay, the last question. Do you have enough variation to look at nationals versus foreigners separately? Would the latter have less money illusion?
So we do, but we try to make life quite hard to ourselves. So of course, so 70%, about 70% of the traders are German. So we have quasi 30% of traders that are not German. So we run a first specification, we compare with 70% to everybody else not German. And then we restrict the amount of variation, making ourselves life harder to find the results, because we're going to look at people that are living particularly close to the border. And then we're going to look at people that look similar to our German customers via propensity propensity score matching. But unconditional, almost 40% of the traders are not German. So that sounds pretty good number. So the trick then is to make them similar enough to the German traders.
Okay, thank you, Fabio. Time's up.
Thank you very much.
I think we can stop here today. Thank you so much for the wonderful talk. And thank you, Andrew. Thank you, Professor Zhu Chen, for the
Thank you very much for all the comments.
Discussion. Yeah, now let me announce our next event. Next Thursday, we will have a very special and interesting webinar presented by Professor Joachim Wolf from University of Zurich. So as you can see in the screen, the topic is how not to get published. I think this is particularly important and useful, especially for the young scholars and PhD students. Professor Joachim Wolf will introduce some important issues in publishing paper according to his very rich editorial experience, being the editor of, for example, Exploration in Economic History, and also the currently editor of Economic Journal. So welcome to register to attend this important seminar next week. So of course, Fabio, welcome to join us next week.
Yeah, thank you.
Yeah.
For sure.
Well, so thank you again, and see you next week. Bye-bye.
Yeah,
Thanks a lot. Bye. Thank you.
Bye.